This is going to be on a topic about wealth building, wealth planning, and why your assumptions are completely effing wrong.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
So this is John Smallwood on Money Isn't. We've had some pretty exciting shows over the last few weeks with some really great guests, more guests in the queue. I'm really excited to be here today. My goal in this show, Money Isn't, is to explain what that is and why that is. Because when you hear it, money means different things to different people at different times, okay? Based upon your emotions and how you feel about certain things. And you either are attracting money or you're pushing money away, okay? And what I want to do today is when you think about money in your future, everybody always perceives their future as a better, more compelling, not everybody, but a lot of people, right? At least I do, that there's this compelling future that's in front of you and you're moving towards something. But a lot of people are moving away from stuff and they're afraid of running out of money and they're afraid of certain things. And that's actually happening. Okay. Meaning their strategies, because they feel the way they do about their money, is actually being pushed away from them. A lot of people come in, not even come in, I meet them socially and they're like, oh, I've heard about you, or I need a financial advisor. When I get money, I'm going to come to you. And my question is like, don't you have a job? So you have money, right? What's your plan and when are you going to start? Everybody listening to this podcast, to this YouTube, to this recording has a plan. Whether you have a written plan or a formalized plan, or you're following your neighbor's plan, you have a set of sequence and plans and repeating patterns that you're doing today. You get a paycheck, you spend it. You don't invest. You get a paycheck, you invest, you trade, you do something. There's a pattern that you're doing. And that is your plan. The question is, where is that plan taking you? And are the assumptions that you're using going to guide you in the right way? Is the plan that you're following taking you where you want to go? Or is it taking you where somebody else wants you to go? Think about that for a second. Really think about that for a second. Am I taking the actions towards the future that I want? So you think about what makes up the elements of your financial plan. It's your career, it's your income, it's your job. Are you becoming, and this was from an earlier podcast, curious about being the best possible person in your career field, in your job, in your space, the best at what you do? Are you taking action towards doing that, which will drive your income up, right? It will. Are you putting away the right amount of money off that income? Are you reducing your taxes to the fullest extent that you possibly can? Are you, where you're saving money, are you minimizing the taxation of the compound? You know, when the money's compounding, are you minimizing the compound taxation? Are you minimizing the compound fees? Or are you compounding taxes and compounding fees, driving less and less wealth in your future? Where the pressure, I talk about a thing called financial pressure. We all have it. It's both positive and negative, meaning positive financial pressure is pushing the wealth curve up. Negative financial pressure is pushing the wealth curve down. And the idea is you need to get a balance that's somewhere between those two elements where the positive pressure exceeds the negative pressure. And pressure comes from overspending, comes from bad planning. It comes from a whole not planning, right? Being a victim as opposed to being in charge of your wealth. And this is, I don't care if you have 300 million, you have 300,000, you have $300. These principles apply to you. Okay. And the situation is this. There's a screen recording. So if you're watching this on YouTube, you're going to see the screen recording. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. And I'm just going to make a little slight move in my timeline here. We're going to make this a 35-year-old as opposed to a 25-year-old. Just makes it look better. Okay. Here's my point is, so everybody has an exponential curve that if you're going to go from, 35 to 70, and if the longer that you go, if you go out to 100 on this curve, right, the potential for your wealth is off the charts, right? The dollars you put away today, 65 years from now, are worth a ton. Warren Buffett is your shining example, right? He was worth $1 billion when he was 56. He's now 92-ish, right? He's worth, I don't even know, a lot. I forget, it's over 100 billion, right? So the compounding, if you look at the screen, the wealth, this person, the way I'm running this is ridiculous math. It's 200 million, right? $200 million of wealth potential, from 70, actually at 70, at 80, from 80 to 100, most of the wealth is created when you see this, because it's gone from 200 million in this particular case to 1.2 billion. That's the majority of the money. So what I want you to start thinking about is you have one lifetime and one lifetime economic curve. Every time you break your curve, you break your potential. And what do I mean by breaking the curve? There are certain things that I know that I have to do, that I need to be prepared for. You might have 4 kids, like I do, and you want to send them to college. So you know that expense is coming. Every time you write a check to the school, you're actually breaking your compounding chain. But the investment in the kid is a return in itself. And are you getting the return on that investment from that child? Are they becoming the best version of themselves? Or are they just going off to school to party? 2 different questions, right? We're not going to dive into that on this conversation, okay? But you can see that investment has value. Other people look at it as it's an expense. And I remember one of my kids came home from school and they were getting ready. They were sophomore or junior year, and the guidance counselor said, your parents hate writing these checks. And my kid raised his hand and said, my dad loves to write checks for school. That's what he tells us all the time. He loves to write checks. And the guy said, your dad's insane. Nobody likes to write checks. And my position was, I do like those. I love to write those checks because of what I'm getting in return from it, which is a kid that is incredibly successful. I don't, if I write the check and they're not going to class, that's a whole different story, right? So there's a certain energy and an expectation that comes from this. But when I birthed the kid, I remember sitting there with my first kid, like 2 days home. And you guys, if you have kids, you are like blown away that you actually have this thing, this thing, right? This alien has showed up, right? No, but this thing, this person that you've created with your spouse is, you want every single thing possible for this kid. You want to protect them. You want them to be the best version of themselves. And do you actually make the right investments in these children, right? Are you giving them the right skills? That's a whole other conversation. But I want to come back to it. It's like every time I pay more taxes, that's breaking my compounding chain than I'm supposed to. If I pay more taxes than I should, that's a break in the compounding chain. People early on in my career, I'd say, I'd meet somebody, and I still meet people in this way, and they come in, they're making really good income. They don't have much in the bank. They got some money in their retirement plan, and they've got like $50,000 worth of credit card debt, and it's like 18%. That's breaking the compounding chain. Like, what happened? Why did you have credit card debt? Well, this happened, and this happened, and this happened, and this happened, and now we're here and we can't get out of it. So there's a cycle, there's a pattern that's going on. The money's being saved and created and pushed in the wrong methodology, right? Because you don't have access to money. So it causes like, hey, you're making 8% in your 401k plan, but you're paying out 18% in the credit card debt. That's a bad trade, right? But not the purpose of this conversation. So I'm going to move the timeline back. I just want to make the curve, I want to make it less exponential. And I want to just look at this over like a 35-year time frame. And I want to create an environment in this where we talk about the variables. So when I look at this, there's a current age and we're saying we're at 35. We're going to break our portfolio down into, hey, we're gonna invest 60% of our assets in the S&P 500 for simulation purposes and 40% in short-term bonds, like the Barclays Ag. Okay, that's going to be our investment strategy. We're defaulting. The person has $250,000 worth of income. They've accumulated $500,000 in their, non-qualified brokerage account of 35, which, hey, that's pretty damn successful, right? For a lot of people. They also have $500,000 in their retirement plan. They've been putting away, $10,000 to $15,000 a year into that plan, and they're getting a $4,000 corporate match. Okay. They have a couple kids, and they're going to have college and weddings and all this stuff that's going to come up. And, we're not showing any inflation on the income. So we've got $250,000 worth of income. And the lifestyle, we have them saving 16% of their net income, of their gross income, right? So they're putting away 16%, which is a magic number. Like, I wish everybody did that, okay? And what I want to show you is if I just pick an arbitrary spot out here on this thing, and if you're looking at this, you see the red curve with potential, and then you start to see this green line start to develop, right? And that green line is the embedded tax liability that is in this person's retirement plan, right? So the simulation of the market data that we're using, which is, 1989 through 2023, we can slide the scale back and look at different time frames. We're just using this time frame. The market, this 60-40 mix, did 9.44%. So if I'm planning with 9.44%, that's pretty powerful. Most people don't make that on their portfolio every single year, okay? It doesn't happen that way, right? But what your spreadsheet, and I see this all the time, the spreadsheet is like this fabulous thing. Everything's going to be fine. So I just want to park a date here. I'm just going to use 668 on this screen. So if this person is doing this all the way out to 68, the total net wealth potential before taxes, before inflation, before all these things is $73 million. And there's an embedded tax liability in the 401k of about $12 million. Meaning on the balance sheet, if I have, in this particular case, I have $34 million in the 401k plan, asset. Embedded tax liability, 12 million, 500 and something thousand. So my net wealth is that way. That tax has been deferred. That tax needs to be paid. Most people don't put this on their balance sheet. But what I want to do here is I want to simulate something that if I do taxes on the gains, you now start to see the curve drop from the taxes that are being paid. So now when I just put these two side by side, 401k still has the same amount of money, but the non-tax 401k money that was 39 million and the other strategy is now down to 22 million. That's an opportunity cost on the taxes that are paid. The taxes compounded along the way, creating a tax drag, right? So that's the first loss that we're going to see. And then there might be investment management fees. There are investment management fees on everything that you buy. They're either visual or non-visual, okay? So those fees now drop that wealth down. And if you're looking at the same 68 time frame, that money's been eroded also. And there's fees inside the 401k, which we don't have embedded in that strategy. It's only on the non-qualified money in this visual that I'm trying to get you to see. But now your wealth has gone from 73 million to 49 million. Pretty decent, right? But you lost $30 million. 26 million. Then what you have is, does the stock market go up and down does it go up every single year at this flat rate? And does the bond market go up? Or do they have what's called volatility adjusted returns? And for the sequence that I'm viewing this, if I hit this volatility adjusted returns, you see different inflection points, and that at that same 68 marketplace, the way the volatility adjusted returns are, it's actually bringing you back up to 59 million. And that's pretty interesting, right? Because they can either go against you or they can go for you. And I talk about this in the book, It's Your Wealth, Keep It. If I have a sequence of returns, and I just want to take a little bit of a minute here to explain this, plus 100 is the first number, minus 50 is the second number. You take the average of plus 100 minus 50, the average is 25. So pretend for a moment I have a sequence where I make 100% the first year and 50% and I lose 50% the second year. My average rate of return over the 2-year period is 25%. If I put that into my spreadsheet and I say the average rate of return is 25%, I create an expectation of return, which means my 100 goes to 125. At the end of the first year, 125 turns into 156. And everybody goes, yeah, that's right. And if you want to win a dinner bet tonight, you kind of have this bet. If I follow the sequence of the return and I do what's called volatility adjusted returns, the 100 actually went to 200. The 200 actually falls down by 50%. It's back down to 100. Your volatility adjusted return is 0%. If I change the sequence and I have $100,000 that goes down 50% the first year, I'm down to 50. I go up 100%, I'm back to 100. So I have a 0% thing, an actual volatility adjusted return. That's completely different than the volatility adjusted return, okay? So what I want to focus on is, as I start to change the variables on this strategy, right? So what we have is a lifestyle cost in this that's $170,000 per year. If I inflate that by 3% a year, the wealth is now dropping, right? Now back down to $32 million, assuming my income didn't go up, right? If I start to say, well, I have kid one, I'm going to put him through college. It's costing $50,000 in today's dollars, which I just talked to somebody the other day, and their kid's going to cost $86,000 for this year. And then there's college number two. The college one and college two in that same sequence at 68 has brought the wealth back down to 23 million. So all that excess money that you thought you were going to have is now being eroded, and there's actually no money in the money's all in the retirement plan. There's no money outside, which is one of the problems that happens. And I'm free-forming this presentation as I do this, right? Because the reason why I'm doing this is I want you to think strategically. that the projection into the future, why you want to simulate volatility and other things, how it plays out is completely unpredictable. And as you start to move the levers in the plan, which is income times savings rate times the length of time that it's going to sit there and how it's taxed and how the deferral tax works, right? And what college costs or what college doesn't cost, right, is going to impact the plan in a unique way. So a projection longer than a couple of years is simply hypothetical, right? It's not taking you where that is because everything is going to change, okay? So what I want you to see here is I now basically say, well, oh my God, I got a kid that got engaged last Saturday. I had no idea that it was happening. And it was pretty cool. He, Jared, put a ton of energy since January in this planning. He bought a ring. He planned. He got her family involved. He got her sister involved. He got everybody involved, except for us. So we're all like, dude, what happened to us? He was like, somebody else needed to be surprised. Couldn't just be, me. And he got engaged. And now it's like, oh, we got a wedding. That wedding's now, we got an expense on a wedding. We got an enjoyment, right? It's going to be, we need a wedding photographer, right? We need somebody. We need all these things, right? So you start looking at saying, well, now that I have these 2 weddings in my curve potential, and here's what I see this all the time. Husband wants to spend X because he doesn't want to part with money. Wife wants to spend Y because it's the greatest experience of her life. And sometimes those roles are reversed. Not often, but sometimes they're reversed. So, what I have in here is I said, okay, when we're 65 and 67 years old, there's going to be 2 weddings, right? So 65 on this curve happens to be a down market. Who wants to write the check for an inflation-adjusted $351,000 wedding, which in today's dollars, the way I threw this in, was $50,000. And we have a 5% inflation rate on that. If you made it 100,000, like in today's dollars, and you're 35, what would that be, right? But now that wedding at 68 is, we got 2 weddings, 2 colleges, and a whole bunch of, whatever. We're now down to $22 million. Now, we're using current tax brackets. Can you predict what's going to happen to the tax rates in the future? I can't. I did it's really old. I look really funny in it, but if you go to the YouTube channel, Money Isn't YouTube channel, it's an old wealth curve video on the history of the U.S. marginal tax bracket. And there's a period where the top federal bracket is 90%, and it's 21 years. Do you think that might have an impact on your wealth? And right now we have the thing coming up in the 2025, the current tax law from 2017 is going to sunset. We're going to go back to the old taxes. So if I just say, top bracket, we're going to go back to, this is just saying 37 and 20. 37 and 20, the increase of the taxes has us at $2,600. Meaning $2.6 million, excuse me. And then, is your salary really going to be flat at $250 for the rest of your life, or are you going to have a future increase? I don't know. And you don't know. I'm going towards a target. I want more. I want to create more. I want to create more value. But you may be in an industry where your income goes down, right? But your expenses are going up. But let's say I go up at 5% a year. Curve makes another change, right? And I want the visual to see that. And what if the capital gain rate goes to 40%? Why the tax rate was 90%. So was the capital gain rate. They were pegged together. It wasn't until the early 90s where where they became dislocated when we went to the 36 or 39.6% tax bracket in the early 90s that they said, we'll have capital gain rates at 28%. So if we make this 28%, it's putting pressure. So what I want you to get from this is that the simulation, and we use simulation, right? Because simulation is important, but what we don't do is we don't simulate smooth rides, right? You start to see in the industry, even from a compliance standpoint, they want you to use a thing called Monte Carlo simulation. And Monte Carlo simulation is kind of interesting, but what it does is it takes 1,000 iterations of the market or multiple thousands of iterations and says, based upon past performance and the way the assets are done, the return on the portfolio should be this, and it gives you a smooth ride. Nobody gets a smooth ride. Nobody gets a smooth ride. The markets are going to be volatile. The markets are going to go up and down. The interest rates in the economy will go from, 1981, the 10-year Treasury was 15.8%. It was below 1% 2 years ago. It's now in the 4.2, 4.3 range as we record this. Who knows where it's going to be 5 years from now? A bunch of people are predicting where it's going to go. My point is, in this whole thing, if I change one or two variables on the simulation, I'm going to get a different outcome. I don't mean this to be defeating. What I mean this to be is the success of the financial plan, the wealth plan, the wealth curve blueprint plan, the wealth, whatever you want to call it, comes down to having really good one-year plans and doing frequent updates and reviews. Like, you could be in an industry where you went from making $200,000 to $2 million. We've had that happen to a lot of clients. A lot being more than 3. Okay? Where they were making, they were in one business, got pissed off and left and went out and opened up their own business and became incredibly successful. That happens. We have a whole bunch of other stories that are on the other end of that. They were making $2 million and they ended up making $500,000, which is a lot. But when you're used to making $2 million, you go to $500,000, the adjustment is really difficult. Okay? So what I want you to think about is a plan for a $200,000 a year income is different than a $2 million a year income because there's different psychological things. There's different spending habits. There's different things that need to be put in place. And the principles that are going to apply are going to be the same thing. It's, are we putting away? Are we saving? Are we investing in the right areas? Are we putting away the right percentage? Are we keeping our housing? Are we keeping our lifestyle within check? Are we overspending or are we underspending? If you're underspending, you also have to have enjoyment because we know life is short for some and long for others, right? So there has to be a balancing act of what this is. But what you want to do is you had a year that was either the same as last year and you stay on the same course, dramatically improved, or dramatically down, or somewhere in between those, right? And how do I adapt and adjust my plan? Well, with it, if I'm making more income and having more assets, with it becomes the need for more protection. So what I see is somebody went from, they weren't making any money and they've created wealth that's, fabulous and they're making $1 million a year, but their plan still looks like they're making $100,000. Not a good plan, right? It's now vulnerable. The variables are changing. The assumptions are changing. If I think about my 34-year career, the amount of tax law changes and market fluctuations and estate planning rules that have changed and products that have come and gone and changed and the amount of access, to different types of products. Like, the stock market has how many different layers of that way you can invest. You can invest directly in a stock. You can buy a unit trust. You can buy a mutual fund. You can buy an exchange traded fund. You can buy an exchange traded note. You can buy fractional shares now. Like it's the same asset class, just different methodologies of which you own it. How you own it, how you get taxed, all those things are really, really important into long-term accumulation. If I can make more money and I don't, there's an opportunity cost. If I can save more money and I don't, there's an opportunity cost. If I pay more taxes than I'm supposed to, there's an opportunity cost. If I think about this, and I want to be really, really clear on this. You make, in my simulation here, it's $250,000. You're basically, in the first year of this, you're putting away I gotta get the right one. I gotta get the red one as opposed to the blue one. You're putting away $130,000 in this year because everything is so wonderful, right? Your income is high. Everything is there. The income is really high because I got the inflation rate on this, right? But somehow out here, you're not doing it. Are these macros? Are you putting away that right amount of money? So if the person's making inflation adjusted, he was making 5% increases, he's now earning or she's earning $400,000. And we're putting away $130,000. Math seems really, really good. But where's the money leaking out on the other amount of money? So let's call it 400. It's down to 350. If I can go into that 350, improve your lifestyle, and take more money and bring it over. Let's say we can get $15,000 of waste that's leaking out of the side. So your savings rate goes from $150,000 to $165,000. Your lifestyle has not changed. What are the odds of that plan having more success and having more opportunity to overcome the obstacles that show up? Getting to retirement and not having money is not a good thing because now you have to rely on your kids. You have to do these things. You are in control of your plan. You are in control of what the action that you take. So when you do this, if you take the mindset of, I want to create long-term wealth for myself that is going to go to the next level, and I'm looking at where am I going to be at age 90, age 100, age 120, what am I going towards? And do I have enough money if I retire at 62 to get me beyond age 85, to get me beyond age 90, the way I want to live? Am I living the right balance today, right? And it's these metrics that the best thing that I'm doing is you want to create the right blend between lifestyle, taxes, and savings so that you're living a fruitful, enjoyable life, but you're also putting away money for the future. Like if I think, and this may or may not be what's going to happen, right? And I'm hoping the opposite happens. Let's say I'm making $500,000 today, and 5 years from now, I'm only making $250,000. Right? Like, can I react to that? Or my wife and I are making really good money and we have 4 kids. My wife now stays home. And I lose that income. How do we adapt? Right? Like, these are things that in a really good planning process, you want to figure out your future and you want to figure out what are the things that we want to have happen. Like, I want to have kids. I want my wife or my spouse to take care of the kids and stay home because it's wonderful. Or I want us to both work. I don't care what it is. I just want to know what you want, right? And then how do we design the future and the plan today that you take the actions towards what you want in the future? And that you keep coming back and saying, new tax law, new opportunities, new changes, market volatility, market's down. Do I have money to capitalize on that, right? What do I want to do? And that's the future. And the present is a snapshot of the way you think about money. And the key is in the Wealth Curve Blueprint, you get a snapshot. Like, this is where we are. And tell the truth. If once I tell the truth about where I am, and I can confide in somebody that this is where I want to go, these are my goals, my dreams, my vision, and you don't hold back. You literally spill your guts to us, right? I have clients that basically tell me this is the only place that they can talk because nobody else in their household understands what they want, and they're scared. This is what we do. We want to help you get where you want to go. And we do not want to be a limitation or a cap on that. We actually want to pull the Band-Aid off and help you become the most successful version of yourself. Yes, as you become more successful, so do we, because we have great clients, right? You're going to refer us more. You're going to do all those wonderful things. If we don't do that, then you're not going to work with us, right? So I just think it's one of these things that I really want people to understand. The variables and the assumptions are the kiss of death if you look at them as unchanging and unwavering. And I'm going to say this. We didn't talk about inflation. We didn't talk about planned obsolescence and technological change. We didn't talk about any of those factors that are going to impact us. We left off probably 300 variables. I'm just going through the big ones, okay? So I want some feedback. I want to hear whether you like this conversation or you don't. And I want to know from you what you want to hear more of, what you want to hear less of, because it's important to me. Because what I want to do on Money Isn't is I want to provide as much value to the listener, to the people that can benefit from this, to get the right information, to make the right choices. So I thank you for listening. Share this wherever you share with whoever you do. Subscribe to it on either YouTube or whatever podcast medium that you use, and give me feedback, because that's how we're going to get better. Thank you. Great to talk to you.